Good morning, everyone, and welcome to a new edition of Merrill's Monday Morning Market Madness. Coming at you today, taking a look at the housing market in the Phoenix metro area. We'll be discussing, trends and topics and what average prices have been doing, and discussing a little bit the cool off that we're seeing in the market. And then what I'm most excited to talk about today is a breakdown of what kind of return on your cash you could expect to see on a very typical investment. And today I'm focusing on the cities in the East Valley. If you're not interested in the East Valley, I plan on doing another episode where I'll focus on more some West Valley or mid or north area cities to show you a breakdown of some of those numbers as well. But I think today's episode will give you a really good understanding, because I think there's a myth going on right now, a narrative that prices are just getting too high and that there's just no money to be made in real estate and that it's not a good time to invest. And I'm hoping to dispel that rumor, because we're still seeing some pretty incredible returns on the rental market right now. So we've been buying up rentals, and I think it's an amazing time to invest because of how low interest rates are. And I'm hoping to convince a couple of people who maybe been on the fence that they might want to look at doing that. But before I get into those numbers, I'm going to start with the month supply of inventory number. So right now we're sitting at 7,754 active listings in our MLS. There's 12,800 listings that are pending. Only 7,482 homes have closed in the past 30 days, giving us a month supply of inventory of 1.04. This is the first Monday Morning Market Madness episode that we've ever done, I think, or at least in a very long time, with a month supply of inventory above a 1. That means that, right now the total number of homes that have closed over the past 30 days, there's slightly more active listings than there are what is selling in a 30-day period. But keep in mind, there's almost 13,000 listings pending, and we're still seeing a pretty darn competitive market out there. I'm seeing so much more news and national whatever about the market slowing down and prices are turning, and I am still maintaining that is not going to be happening anytime soon. A month supply of inventory of 1 is still an extreme seller's market. A balanced market needs a month supply of inventory of like 4 or 5 months. So unless we're going to somehow pull out another 30,000 active listings in the next couple of weeks, we are going to be heading into next year still very much in a very, very strong seller's market. I believe that what we're experiencing right now is just normal seasonal slowdown. The market always slows down this time of year, and then it picks up again as we head into the spring. In fact, last year was a bit of an anomaly. I think some people are looking at the numbers like, oh, well, last October, and I have last October's numbers. Last October, 10,026 homes closed in the month of October. This year, only 7,930. So that's a 20% decrease in units from this year to last year. But last year was an anomaly because of COVID. Normally, our biggest months of the year is like May and June. Well, that was right when we were in the peak of everyone not even sure if they could leave their houses. And so we saw a huge drop in sales numbers in May and June. And then July, August, September, October were way higher than normal. But if you go back to 2019, 8,039 homes closed in 2019 versus 7,930 this year. So almost identical to October of 2019. And in 2018, only 7,300 homes closed. So very, very typical October that we are experiencing right now, despite home values being way up. Here's another metric to consider. So the average sales price of all the homes that sold in our MLS in the month of October was $521,581. In 2020, the average sales price was $428,000. So almost an increase of almost $100,000 in the average sales price from October 2020 to October 2021. Going back to 2019, it was $346,000, and in 2018, it was $326,000. So an increase of almost $200,000 in the average sales price in the past 4 years. The other metric that I found really interesting and really telling of, what kind of market we're really in right now is the sold to list price ratio. So you take all the homes that sold in our MLS in the month of October, on average, homes were selling for about $700 above the list price. So on average, homes are still selling above asking. If you go back to 2020, even though we were in a fiery hot market then as well, in fact, probably a little hotter than it is right now, homes were still selling an average of $6,000 below the asking price. Go back to 2019 and 2018, both of those years, homes were selling an average of $7,000 below asking price. It's always been pretty typical for homes to be selling somewhere between 1% and 3% below the asking price. But now we are still, homes on average are still selling slightly above the asking price. So don't let the narrative fool you that the market is shifting and that home values are going to somehow start plummeting. There's really only one major thing that I think could absolutely cause our market to come to a big slowdown, maybe to the point where home values could fall slightly, and that is interest rates. And I'm going to share my screen here with you real quick. Now, interest rates, let me be clear on interest rates before I show you the screen. Interest rates, if they go up a lot, it could see a slowdown in the market because it has a big impact on affordability. I really don't think it's a situation where we're going to see interest rates suddenly go up to 7% and home values are going to plummet. I just think most likely interest rates will continue going up slowly, and the pace at which homes are selling will slow down slightly. Worst case scenario, maybe home prices dip, I don't know, 5%. I really honestly, genuinely doubt that happens. But just, that's my opinion of the worst case scenario. So let me jump in here, share my screen with you and show you interest rates. This is according to Freddie Mac's website. The 10-year Treasury note has been trending up due to a decline in COVID cases. If you look at this blue line, it shows you what average interest rates have been over the past year. And right now we're sitting at an average on a 30-year fixed rate mortgage of 3.14%, which is near the 1-year high of 3.18%. So still slightly below where we were at in April. Again, take it out to the 5-year or the 10-year or the all-time, and rates are still ridiculously low. I honestly think rates would probably have to go up closer to 5% before we would really see some sort of significant reversal in the market. Now, I want to shift gears now and talk to you guys about the rental market. I'm really, really passionate about owning rental properties, about helping people to begin investing and buying rental properties, and also educating people about owning rental properties. And I apologize, this is going to be a little geeky, but I'm a numbers guy, so bear with me here. I went ahead and put together this spreadsheet. I'm going to see if I can zoom in on this just a little bit so that you can see my numbers a little bit better. There we go. Now I've got them in alphabetical order. So Chandler, Coolidge, Florence, Gilbert, Maricopa, Mesa, Queen Creek, and Santan Valley. Now, what I did was, in order to just kind of make it a fair comparison across the board, is I looked at, if you go down here to where it says parameters, I'm using homes that are single story, 3-bedroom, 2-bathroom, 2-car garage between 1,200 and 1,800 square feet, no pool, not in a 55 plus community, on a lot size below 8,000 square feet, and built after 1980. So that way, everything that I was looking at in each city would have the same rules. Okay. And what I did is I said, okay, let's look at Chandler. What was the average price for that kind of home in the past 30 days? And it was $442,000. So I'm not even saying you go out and find a deal, just buy the average house. Okay. You put 20% down on it because that's what you're typically going to need on a non-owner occupied. I do have access to a 10% down non-owner occupied program if you want to hear more about that. Which means that your average mortgage on that home would have been $353,653. Your average monthly payment on that house would have been $1,829.49. I'm using a sample rate of 3.75%. Keep in mind, even though you just saw the average rates were 3.14%, non-owner occupieds are a little bit higher rate. This is one of the reasons why we really like to recommend house hacking. If you're just starting out, you're a single person or you don't have a big family yet, it really works out great if you can buy a home as your primary residence, live in it for a year, turn that into a rental, and then go buy a different primary residence. But for those of us with 7, 8, I don't even know how many kids anymore, that's really hard to move your whole family every year or two. So I'm sticking with the 20% down and using investor financing. Okay. I'm using $600 a year for the insurance, which depending on the house, that might, I've got several properties that are less than that. I've got several that are a lot more than that too. So I'm just trying to go with middle of the number roads. And then I also just took for taxes, I just kind of took the median property and kind of average taxes. All right. The average rent for the exact same parameters over the past 30 days was $2,181, which means that your monthly cash flow would have been $351.51. Annual cash flow, $4,218, which is a return on your cash of 4.77%. Not super exciting. I get it. That especially when you start considering maintenance, vacancy management, not a home run on the return on cash. Obviously, if you decide to buy a rental, we're going to be looking for something that's a little bit better than the average deal, right? And we're probably going to try to push the limits a little bit on the average rent, and some of those things there to help improve that return a little bit. But you can see I've got the same numbers for all of these other cities. Coolidge came out by far, not even close, as the best return on cash. Part of it is you'd need such a lower down payment. The average price for that home was only $253,000. Average mortgage was $1,063, while the average rent was $1,624. So Coolidge came out with a pretty nice return. And that's just your return on cash. So I understand if these numbers. First of all, I just want to point out that this, even with these numbers, you have an opportunity to buy a house that someone else is paying for, and now you've got this incredible asset that over time is going to go up in value. But where it gets really exciting is not this first year when you own the property. Maybe the first year your return is only May. Talk to anyone who's invested in rental properties over the past 5, 6, 7, 10 years. Okay, where it gets really exciting is when you buy a home with a mortgage, you get to lock in your payment for 30 years, right? But you get to continue renting it, and rents never go down ever. Okay. Even in a down market, rents will at least hold stable and most likely rise. All right. Think about it. If the market is down, people are losing their houses, and what do they have to do? They have to go rent. Okay. So it puts, even in a down market, it tends to put upward pressure on rental prices. So where it gets really exciting is in my next spreadsheet, where we look at what happens to your return on cash a year later if the market goes up by 8%. Now, the market, in my opinion, will go up by more than 8%. I'm predicting average prices will increase probably somewhere in the range of 10 to 12%. We've seen an increase of somewhere around 20 to 22% over the past year. So I'm only talking about doing half, but I've seen some slightly more conservative estimates. So I'm going with 8%. All right. So let's keep our Chandler example here. I'm just using Chandler because it's the first one on our list. This first part of the spreadsheet is exactly the same, but I'm going to come over to this blue field now. And I made it blue because this is a projection, not a guarantee. This is, just saying what happens if prices go up by 8% over the next year. Well, your house that you bought originally for $442,000 is now worth $447,000. The rents will also go up. If typically what we've seen, it's not an exact correlation, but if average prices go up by 8% on the sales, the rents are probably going to go up at least that much, if not more. And so now your new rent is $2,355. You were renting it for $2,181. So that means that your cash flow is now $525.99. So instead of $351, you're at $520. You gained almost $200 in just 1 year. Just 1 year later, you've gained almost $200 a month in cash flow. You do that year over year over year over the course of 7 or 8 or 10 years, it really compounds. But don't forget, the value of your property also went up $40,000. So when you combine the value of your equity being up $40,000 and your new cash flow at $525.99, your new return on cash is 47% just a year later. Okay. So if you are beating 47% in the stock market or in your other investments, then by all means, please continue to do those. But if you're a meekly, 10 to 20%, like I think most investors are, then or less, then you might want to look at real estate. We have helped a number of people who have maybe pulled cash out of their house, with interest rates, depending on where they got their original mortgage. They were able to pull some cash out, keep their payment very close to similar, and now they're buying other assets that are producing a huge returns on their investment. And of course, owning investment properties also comes with the great convenience of being able to do 1031 exchanges. And this is just 1 year. I kind of want, the part of me wanted to go on and start showing you what it would look like in 2 years if the market goes up another 8% the next year, or even 6% or 5%. You'll have a more than 100% return on your investment literally in just 3 or 4 years once you factor in the cash flow on the rental and the increases in value. And now I get it. There's no guarantee that the market is going to keep going up forever. But keep in mind, with even in down market, your rents will at least hold stable or likely rise. And you have locked in a home at a 3.5, 3.75%, maybe even a 4% interest rate for the next 30 years. Honestly, I mean, no one's got a crystal ball, but in my personal opinion, unless there's some sort of incredible catastrophe that ruins us all, okay, you will always have positive cash flow on that property. So if there's anything more I can do to convince you that you ought to be investing in real estate, please let me know. And again, I will come out with a new episode next week, start with these exact same numbers, but looking at some different cities to give you an idea of what those breakdowns are. If you want me to share this spreadsheet with you, I'd be happy to do that as well. Stop my share here because that gets weird looking. Anyway, I hope you found this helpful or informative. I'm sorry if I'm a little geeky. I love looking at these numbers. It's really amazing. And I'm really passionate about helping people invest in real estate. And so if you're thinking about doing that, please reach out to me. We can see if it makes sense for you. And hope you all have a great week. Thanks.